Chapter number 6, Financial Statement Analysis. Financial analysis. It is a process of analyzing and interpreting financial statement. Analyzing means simplifying the data and interpreting means explaining the meaning and significance of the data so simplified. Financial statement. It is the outcome of summarizing process of accounting. It includes profit and loss account, balance sheet, cash flow statement, statement of shareholder equity, means of conveying to management, owner or to investors or outsider a concise picture of profitability, financial position and cash position of the business. Its purpose is to convey an understanding of financial aspects of business firm. Steps of financial analysis. Establish objective of analysis, defining extent of analysis, organization and rearrangement financial data, relationship among financial statement with the help of tools and techniques, interpretation of information, drawing a conclusion. Ratio analysis, liquidity ratios, leverage ratios, activity ratios, profitability ratios and other ratios. Liquidity ratios. Current ratio is equal to current asset divided by current liabilities. Measure ability to meet short-term cash needs. Quick or acid test ratios. Quick asset divided by current liabilities. Quick asset is equal to current asset minus inventory minus prepaid expense. Measure ability to meet short-term cash needs more rigorously. Leverage ratio, debt to equity, is equal to long-term debt divided by shareholder equity. The debt equity ratio indicates what proportion of equity and debt a company used to finance its assets. Debt to capital, long-term debt divided by total capitalization. The ratio is used to evaluate a firm's financial structure and how its financing operation. Debt ratio, total liabilities divided by total assets. All three measure extent of firm's financing with debts. Turnover ratio, inventory turnover ratio, cost of goods sold divided by average inventory sale closing inventory. Every firm has to maintain a minimum level of inventory of finished good to meet business requirement. Inventory turnover ratio indicate whether the inventory has efficiently used or not. Debtor turnover ratio is equal to net credit sale divided by average trade debtors. Indicate number of time average debtor are turned over a given year. Average collection period is equal to number of days or month in a year divided by debt. Total turnover ratio represent average number of days for which a firm has to wait before its receivable and convert it into cash. It is also called day sale outstanding. Creditor turnover ratio is equal to credit purchase divided by average trade creditors. Total asset turnover ratio is equal to net sale divided by total asset. Fixed asset turnover ratio is equal to net sale divided by fixed asset. Working capital turnover ratio is equal to net sale divided by working capital. Measure efficiency with which working capital is being used by the firm. Profitability ratio. Gross profit ratio is equal to gross profit divided by net sale. Operating profit ratio is equal to operating profit divided by net sale. Operation profit is equal to EBIT is equal to sale minus VC is equal to CM minus CF. Net profit ratio is equal to net profit divided by net sale. Return on equity is equal to net profit divided by total shareholders equity. Return on asset is equal to net profit divided by total asset. All measure firm's ability to translate the sale into profit. Other ratios. Measure of dividend payment. Dividend paid to shareholders. Dividend per is equal to share. DPS, weighted average number of ordinary share outstanding. Dividend paid to common shareholder. Dividend payout ratio is equal to net income attributable to common share. Plowback ratio is equal to 1 dividend payout ratio, the proportion of funding retained by the company.